Hey everybody, this is Alex Merced and you're listening to Mastering Financial Exams. And again, I'm one of the instructors here at Greco Financial Training. We're basically where Wall Street learns the business. So if you haven't been to Greco.com or learned from a Greco class, you can check out a demo of some of our other products and offerings over there at Greco.com/demo. But today we're going to be talking about equities. Equities, meaning ownership in a company. So just to kind of summarize, a company needs to raise money because it wants to hire people, it wants equipment, it wants all sorts of things. But it doesn't just get money magically. It has to do what's called financing, meaning it's got to find a way to get the money. And there's generally two ways to do financing. Either through equity, by selling stock in the company. So basically when someone buys stock, they're buying ownership in the company by putting money into the company. Okay, so if I bought shares of Facebook at its IPO price, its initial public offering price, which is the price, the IPO is the first time the company issued stock to the public. The price that it charged for those shares, which was $38, was called the public offering price, or the POP. If I paid that $38 per share, that money was going to Facebook, so that way Facebook could hire programmers, buy machines, and in exchange, now I owned a piece of Facebook. So now if people ask me, what do you do? I could say, hey, I'm an owner of Facebook, by owning even one share. So that's what you're doing when you buy stock. You're buying a piece of the company. That's called equity financing. It's very similar to splitting a pizza. So if you and your friend ever wanted to buy a pizza together, both of you shared the cost and both of you shared the ownership. That's essentially what equity is. You guys are now both co-owners of this thing, not necessarily in equal amounts, but you guys get to share in the profits and share in the losses. So the company loses money, you lose money, company makes money, you make money. While the alternative is debt financing, where you borrow the money. So this is kind of like, you want the pizza to yourself. So you tell your friend, can you borrow the money to buy the pizza? You eat the pizza yourself, so you enjoy. So basically, you are the one with the stakes and the gains and losses, but you owe your friend money, maybe with some interest. That's debt. So when people buy bonds, that's what they're doing. They're lending a company money and are expected to pay interest or be paid interest regardless of whether the company does well or not. So when you buy stock, specifically common stock, you really have a true stake in the gains and losses of the company. But when you buy things like bonds, you don't. You just hope that the company can continue at least to make enough to keep paying you what they owe you. So you don't necessarily have a stake in the upside, but you can lose if the company fails. So there are different types of equities though. Okay, so again, whenever you think of the category of equity, generally these things represent ownership. There's common stock, and then there's preferred stock. When you buy common stock, it's just a share of ownership in the company. You're not expected to get any kind of cash flow or the price to grow. Hopefully it does, but you basically do well if the company does well. And basically you make money in two ways. If the company increases its earnings, meaning its profits, it can either decide to keep those profits, what's called retained earnings, and because its retained earnings is growing, its profit per share is growing, the stock price will grow. And you'll be able to sell the stock at a higher price and make money that way. Oftentimes when a company gets much later in its life, it's a much older, bigger company, keeping that money inside, the reason you would keep your retained earnings or you'd keep your profits is to reinvest it back in the company. When the company is young and small, that makes a lot more sense. But once you hit a certain size, what you can really do to grow the company with that money is a lot less. So basically, it ends up being much better for shareholders to be paid the cash back. So the company starts paying a dividend, meaning a little piece of its profits to its shareholders, possibly every year, possibly in some years. Every year, the people in charge of the company, called the board of directors, would make that decision. Okay, so every year, if the board of directors decides to pay the shareholders a dividend, you as a common shareholder would receive that dividend. The problem with common shares, though, is that every time you sell common shares as a company, the great thing is there's no strings attached. I don't have to pay you a dividend. I don't have to make sure the stock price goes up. We all hope it happens, but there's nothing I promised you other than that you own a piece of the company. But that means you also get voting power. So you get a piece of voting in the company. And the more shares I sell, the more power I'm giving up in the company. You could run the risk that you give up so much of the company that, you lose control of the company. Great examples of this, and if you ever watched the TV show Empire, or Billions. I highly recommend both shows. They'll illustrate a lot of the concepts we'll talk throughout this podcast very well. But basically, what happens is the company grows and may not want to give up any more voting power. The problem is, if it decides to start borrowing the money, meaning issuing bonds, then it creates a solid liability, meaning they have to pay those payments to the bonds every 6 months. Every 6 months, you got to pay a little bit of interest to the bonds, and if you don't, your company's done. So that's a bit of a commitment too. Only if there was something in the middle. This is where preferred stock comes into play. It's essentially stock. It's essentially ownership in the company without voting power. So you have this stock that has no voting power, but in exchange for generally not having voting power, you get a sort of promised dividend. It's not a hard promise. It's not guaranteed. So if the company can afford it, they won't pay you. But generally, if the company can afford it, they will pay the promised dividend to the preferred stock for that year. And if they don't pay that dividend for that year to the preferred stock, then the common stock cannot get paid anything at all. So basically, preferred stock always gets paid before common stock. So it's kind of in between. We don't have to pay the preferred stock, so it's not a bond. But the preferred stock doesn't have voting power, so it's not quite like common stock. So it allows us to sort of raise money without giving up control of the company, without imposing the financial obligation of a bond. So what's the catch-22? Well, since preferred stock isn't a bond, it isn't a implicit obligation of the company, it's going to be a little bit riskier than a bond. So I may be able to sell a preferred stock. I may be able to sell a bond with like a 5% interest rate and borrow the money at 5%, but I have to pay that 5%. But because the preferred stock is riskier, I may have to issue the same preferred stock for the same company at 7% because of the additional risk that there may be a year or two you don't get paid. So the catch is you're going to pay a little bit more. The cost of that capital is going to be a little bit more than the equivalent bond. But again, you're not giving up voting power, and you're not imposing sort of a solid obligation on the company. So this gives you a little bit more foray into the world of equities. We'll be going into more specific aspects of it as we go along through the show. If you enjoyed what you learned today, do consider buying the full class for whatever exam you're learning over there at Greco.com. We also have our online classes through the Greco SurePass Academy, which there's actually an iPhone and Android app you can download to access your classes, video and audio lectures, PDFs, notes briefs, flashcards, all sorts of cool bells and whistles. Also, we do have live classes. We do tutoring. Anything you guys need, just go to Greco.com and learn about what we offer. Thank you guys very much. I'll see you guys in the next episode.